All right, welcome to this explainer. I am absolutely thrilled to have you here today. If you're someone who really wants to understand where your money is going, but you constantly get bogged down by the sheer volume of dense financial jargon out there, well, you are in the exact right place. Today, we're taking a truly fascinating piece of financial architecture, a brand new offering from Mirae Asset Mutual Fund, and we are going to dissect it right before your eyes.
Let's be real for a second. Have you ever actually tried reading a 50-page mutual fund scheme information document? It is a notoriously tedious, incredibly dry pain point for almost every investor. I mean, it's just pages upon pages of legal compliance, limits, and technicalities. But hidden inside that document is the very DNA of your potential investment. So instead of making you read all that fine print, I'm going to give you a clear, highly visual breakdown of this specific ETF. We're stripping away all the noise and focusing purely on the mechanics that actually matter.
Okay, let's dive into this. Here's our roadmap for today. First, decoding the fund name. Second, investment goals and strategy. Third, inside the asset allocation. Fourth, costs, loads, and minimums. And finally, risks and tracking errors.
Starting off with Section 1, decoding the fund name. Let's make sense of this jargon.
You know, when you look at financial products, a 12-word title can feel, well, incredibly intimidating. But before we even look at the specific name, we need to understand its foundational category. According to the document, this is officially classified as a hybrid exchange-traded fund balanced. So what exactly is the beast we're dealing with here? Exchange-traded simply means you can buy and sell units of this fund on the stock market during normal trading hours, literally just like a regular stock. And hybrid and balanced, that just means it doesn't hold only one type of asset, like only stocks or only bonds. It holds a mix that's specifically designed to balance growth and stability.
Now for that massive mouthful of a name, the Mirae Asset Nifty200 Momentum 30-plus 8-13-year G-Sec 50/50 ETF. I know it's a lot, but the key here is to look right at the very end of the name. See that 50/50? That right there is the golden ratio of this fund. Half of this fund is dedicated entirely to equity, specifically tracking the Nifty200 Momentum 30 index. The other half, that's dedicated to debt, specifically Indian government securities, or G-Secs, that mature in 8 to 13 years. So it's a literal half-and-half split between stock market momentum and government-backed debt.
Moving right along to Section 2, investment goals and strategy, mirroring the index.
Now, what's really interesting here is the precise language used in the official document. The stated goal is to provide returns that are commensurate with the performance of its underlying index. This tells us one absolutely crucial thing. This is a completely passive ETF. The fund managers, Ektagala and Pranav Kulkarni, they aren't actively trying to pick winning stocks to beat the market. No, their singular job is to strictly mirror the performance of that 50/50 benchmark index as closely as humanly possible before expenses.
All right, Section 3, inside the asset allocation, the fund's DNA.
So where is the money actually going? Under normal circumstances, an overwhelming 95 to 100% of the fund's assets must be invested directly in the securities that make up that 50/50 benchmark index we just talked about. The remaining tiny sliver, just 0 to 5%, well, that's reserved for money market instruments. This little cash buffer is kept around just to handle daily operational realities. You know, things like undeployed subscription cash, dividends waiting to be reinvested, or general running costs. They run a very tight ship here.
But hey, just as important as what a fund actually does buy is what it explicitly refuses to buy. The document outlines a very strict rule of exclusion. To keep the fund scope totally focused on that 50/50 Indian index, the managers are absolutely barred from high-risk or complex instruments. I'm talking zero short selling, no foreign securities at all, no securitized debt, no unrated debt instruments, no credit default swaps, and absolutely no real estate or infrastructure trusts. They are keeping this purely and strictly to domestic equity and government bonds.
Let's move to Section 4, costs, loads, and minimums, the functional mechanics.
Okay, it's time to connect all this technical data directly to your wallet. ETFs have this unique dual-layer structure. If you get in during the new fund offer, or NFO period, the minimum application is 5,000 rupees. But once the fund is trading continuously on the NSE and BSE exchanges, regular retail investors can buy in for as little as a 1-unit lot at the current market price. However, there is a third tier for the heavy hitters, and that's the large investor category dealing directly with the asset management company, or AMC.
And to be a large investor dealing directly with the AMC? Well, this is the massive threshold you have to cross. 25 crores. Yeah, you heard that right. If you want to bypass the public stock exchange entirely and create or redeem units directly with the fund itself on a continuous basis, your transaction size needs to be greater than 25 crores. For everyone else, the stock exchange is your trading venue.
Now, why does this distinction actually matter? It all comes down to fees, specifically the exit load, which is a fee charged when you sell your units. If you're a retail investor trading on the exchange, there is absolutely no exit load applied by the fund. You simply pay standard brokerage fees. Direct AMC redemptions also don't carry an exit load for those 25 crore large investors. However, the document does outline a very rare extreme scenario. If the ETF is facing severe liquidity issues on the exchange, like say if it trades at a discount of more than 1% for 7 continuous days, retail investors can temporarily approach the AMC directly to redeem up to 25 crores without an exit load. It's basically a built-in safety valve for extreme market conditions.
Finally, Section 5. Risks and tracking errors. Checking the vital signs.
We really need to check the vital signs of this scheme. Take a close look at the official scheme riskometer. Remember how we talked about this being a balanced fund holding 50% relatively stable government securities? Well, despite that balanced label, this investment is officially rated as high risk. The momentum equity portion of this portfolio carries enough volatility that regulators want you fully 100% aware this is not some conservative safety net.
So the crucial point here is understanding how well the fund actually does its one job, tracking the index. And this brings us to the tracking error. That's simply the expected drift, or the difference, between the fund's actual returns and the index's returns. The document explicitly states that under normal market circumstances, this annualized tracking error is not expected to exceed 2%. This kind of drift can happen due to corporate actions, managing cash flows, or just market volatility during rebalancing.
Now, to manage the fund efficiently and potentially minimize that tracking error, the managers do have a few specific operational levers they're permitted to pull. For one, they can invest up to 20% of the net assets in equity derivatives for non-hedging purposes, which honestly is often a much more efficient way to adjust the portfolio than buying physical shares. They're also allowed to engage in stock lending, up to 20% of the fund's assets, just to generate a little extra revenue. But there's a strict cap of lending no more than 5% to any single broker, just to mitigate counterparty risk.
And that brings us to the ultimate question you have to ask yourself after reviewing the DNA of this document. We've seen the precise 50-50 construction, the incredibly strict index tracking rules, the clear cost structure, and the very real high-risk label. So, does your personal strategy need the specific push of a passive 50-50 momentum to government debt split? Or, despite the balancing act, is that riskometer simply running a bit too hot for your current goals? I really hope this visual breakdown has empowered you with the exact knowledge you need to decide for yourself. Thanks so much for joining me on this explainer, and as always, keep learning.